Hey everyone, welcome back to Finance with Nishant. Have you ever looked at a chart and wondered how in the world are these prices moving? Is it all random or is there something more to it? If you have ever asked this question, then you are at the right place. Every big move that you see in the market, be it an uptrend, a crash, or a sideways market, all of that follow one timeless principle. And that principle, dear friends, is over 100 years old. And that is called as Dow Theory. By the end of this video, we will be looking at what Dow Theory is, what are the basic tenets of Dow Theory, how to identify the direction of a trend, and how to bring in objectivity when looking at the market. All right, let's begin. Even before we start looking at the charts, let us try and get a brief history as to how this theory originated in the first place, right? So this was given to us by Charles Dow, who was the first editor and founder of Wall Street Journal and a co-founder of Dow Jones and Company. He was also a journalist. During his time, he understood one profound thing, that the market movements that we see are not random. All of these movements have a particular structure and that they represent the collective psychology. So in this video, we will try and understand what he meant by collective psychology and the structure that these price trends have. Alright, so now going back to the core question of how does the markets even move, right? So if you have ever looked at a chart like this and saw all of this, at first this wouldn't make any sense, right? But if you try and look at it a little closer, you observe that these markets move in waves, right? That these prices always move in waves. And that is what the Dow theory initially started with. That there is a predictable structure in the market, and each of these waves represent collective psychology of the people who are trading here. Okay, taking this a notch further, if you really have to understand how these structure looks, the best way to understand is to look at it through renko charts, right? So what we are looking at here is the structure that Charles Dow found. So if you see here, the market moves in waves. These waves might be smaller or bigger, but what they show is the collective psychology of the people trading in this particular instrument. Think of the market like the ocean, right? So you'll see the big tides, the smaller ones, and ripples, all moving in rhythm but on different time scales. And when we go a little deeper, we can understand that all of these ups and downs have a rhythmic cycle. And that is why you see that the markets are not linear, but they move in waves. With this understanding, now let us look at the types of trends that are presented in Dow theory. All right. So Dow theory basically talks about three types of trends. One is the primary trend, the secondary trend, and the tertiary trend or the minor trends. All right. So these primary trends can span from months to years. So if I go ahead and choose a monthly time frame here, right? So this shows me a particular trend as to what is happening in the market, what is the wave that it is currently doing. And if I choose weekly, then this shows me a different trend as to what is happening. And the daily one is the smallest one, which we can consider as a minor trend or a tertiary trend. So basically we have three types of trends. Primary, which can span from months to years, and this is the macro trend, meaning the major trend. The secondary trend, which can be between weeks to months, and this is the second level of trend filtering. And the third one is a daily trend, which is also a tertiary trend. This shows us the minor fluctuations that are currently happening within the major trends. Okay. Now that we understand that the markets move in waves, it is important for us to understand the concept of highs and lows. Okay, so if we look at these waves, right? So these are called as swings, and each swing reaches a particular point at the high and a particular point at the low. So what are these points called as, right? So this particular point is a swing high, and this particular point is a swing low. So swing high and a swing low. Knowing this is extremely important. So every time you look at a particular wave, you can plot a swing high, swing low, swing high, and swing low. If we know how to identify the highs and the lows of a particular swing, then we are now equipped to understand building blocks of these trend. So what are those building blocks? Come, let's learn. So here, if we look at this particular movement of the market, I am able to see multiple swings, right? Each of this swing has a particular low, particular high, then a particular low, and then a particular high. Okay. To understand the direction of the market, if the market is moving up in waves or down in waves, it is important for us to understand these four aspects. That is higher high, higher low, lower high, and lower low. Okay. So what is a higher high? A higher high simply means that the current swings high is bigger than the previous high. Okay. A higher low simply means that the current swings low is higher than the previous swings low. Okay. Same goes with lower high. If the current swings high is lower than the previous swing high, then that's a lower high. If the current swings low, which is this point, is lower than the previous swings low, then this is lower low. I hope this is clear. Let us try and plot this in this particular chart that we have. Okay, so this will be my high point. This is my swing low. Okay, now to understand if this is higher high or higher low, I will have to compare this point with this point. So this high compared with this high, now I know that this high is bigger than this high, So this will become my higher high. Okay, and now this is the new low that has been formed. Now I'll have to compare if this new low is higher than the previous low. And when I see, I can clearly confirm that the new low is higher. So this becomes my higher low. The same pattern repeats here as well. So this high is higher than the previous high. So this becomes my new higher high. And here, right, this becomes my higher low. Similarly, higher high here and higher low. So what we are able to understand here is that when the market makes this higher high, higher low structure, that simply means the market is going in an uptrend. Though it is moving in waves, meaning it is giving corrections, the market is still moving towards a higher price point. I hope this is clear.